We often hear that deficits are the enemy of the market. But what if the deficit horse has already left the barn and that spending is actually the fuel for the next leg of the bull market? Today, we're talking about the most consequential president for markets, the 100-year speed run in CapEx, and the global game of risk. Neil Azous is in the house, founder and CIO of Rareview Capital Management. Neil's going to break it all down for us and help us get ready for 2026. Welcome to the Money Runner. I'm David Nelson. Neil, welcome back to the Money Runner. Thanks so much for being with us today.
David, great to see you and happy holidays.
Yeah, you too. It's that time of year. We haven't exactly gotten the Christmas rally yet. I'm still waiting on that. Certainly today wasn't part of that. Maybe tomorrow will be a little better. Neil, everything I said at the top of the show came from your most recent investment outlook. I want to go to a couple of points in this. You argue that we're in a very unique environment where fiscal spending may not be a headwind, but may actually be a tailwind. You have to walk me through that.
Sure. So it's really a collection of thoughts anchored by that fiscal story. And I think in that last outlook, to use some terrible acting, but I like to mention this line from the famous Forrest Gump movie, where he says, "I'm not a smart man, but I know what love is." And what I define as love these days, or kind of what you touched on at the onset, is that the deficit horse has left the barn. And it doesn't matter which party is in charge. They're both going to spend, and they're both going to spend big. And what I mean by that is real simple, is that if we have a budget of about $3 trillion a year right now, give or take 100 billion here or there, we get about 800 billion a year in tax receipts. Maybe we get a couple hundred billion a year in energy exports through crude oil or LNG or liquid natural gas. And we're getting about a couple hundred billion, maybe a little bit more from tariff revenue. Well, we're still out $1.5 trillion. And when you run that math, right, the percentage of that relative to a 30 trillion, roughly 28 to $30 trillion GDP, we're running this deficit to GDP of around 5 to 6%. To put that in context, or to give your audience a yardstick, David, historically we run that between 2 or 3%, and there's only been 3 times in history when it's been above that. Most recently during COVID, when us or the world printed 5, 7, $10 trillion, whatever that number is. And then previous to that was in the global financial crisis. You remember TARP and all those other alphabet soup programs. And then well before we were born in World War II, when we ramped up to having several hundred ammunition factories in the United States.
I want to put a picture on that, Neil, because you got a chart here. Guys, bring up slide 11. And I'm looking at this, and I'm not sure how far back you're going, but just at a glance, it looks like the last time we had a surplus was under Clinton. Maybe. Is there any hope of that ever?
No. I don't. There's only. I mean, that there's 2 ways out of that, right? There is grow your way out of it, or inflate your way out of that. I think that the silver lining in that question is that President Trump and his administration are attempting to grow their way out of that. That's an interesting endeavor versus inflation, becoming a tapeworm and trying to win that battle. How to get there, you would probably need what they would call 5 to 6% nominal GDP growth. So call it 4% GDP, 2% inflation to get to that. Getting that profile has been elusive to the point really since Bill Clinton was there. For any sustained period of time, we'll call it 5+ years. And that was really the ramp up of the internet at that time that he got, from 1994 to 2000. He had the benefit of all that job creation, all that wealth creation. And that was a proper way to grow out of anything. And the last time we had some meaningful surplus in the United States. I think it's a challenge. I appreciate that we would rather try to grow our way out of it versus inflate our way out of it. I don't see a pathway to get there, but I think we can make a good attempt at it. And I think that this is, since it's timely, we're doing this today on December 17th. To be clear, my understanding is President Trump is going to address the nation tonight about next year. And I bet you're going to hear all sorts of big things, such as the interest rate should be 1%. Oil should be $35 a barrel, not $75 a barrel. Right? And the U.S. dollar needs to weaken a lot. Those are ingredients to try to win that battle of growing your way out of that.
Let's zero in on that then, because you mentioned President Trump, and it's right there in your investment outlook. And you say basically he's the most consequential president markets have ever seen. I have to admit, at least in my history of markets, which goes back a decent way, I would have to agree. Can he get all this what he'd like to get done? That seems to be a challenge.
I don't know if he can get it done to the T, but I think he can initiate and drive the direction of all of those that, at least from our standpoint or your audience standpoint, maybe David, that we're going to have to react to those initiatives or actions. And there's probably an investment playbook to go along with those actions that they should be respected. Will those results be delivered at the end? That seems like it's somebody else's problem for us to figure that out. But in the meantime, it's our job to figure out what's in front of us in the next 6 months or 9 months. And I think we'll make a pretty good dent in it. Or at least I would say it this way. It doesn't really matter what my personal views are of him politically, knowing that he's this consequential and knowing what he's trying to accomplish. Grow your way out of it. And then at the same time, tell you that he wants to be in charge of the 3 speed governors of the world: the dollar, an interest rate, and crude oil. That's all that really matters, right? At the end of the day, like, how do we get from A to B? How much does it cost to get from A to B? And can I finance it on my way there, right? And so if he can engineer all of those governors lower, I think it would behoove us as investors to make sure we're on that gravy train, fighting that train alongside what we described with the fiscal and alongside with the Fed. The idea of saying, don't fight the Fed, don't fight fiscal, and don't fight the president, those strike me as sensible views.
Well, one of the areas that he's certainly been consequential has been defense spending, and you talk about that in your note. And I've always had a passion for defense stocks because, at least as a PM, God forbid there's a geopolitical or military event somewhere on the planet, they're the only thing on your screen that's going to be up that day. But you take it a step further. You take it global. Walk us through that thinking.
So by saying something, this isn't my quote. This actually came from there was a TV show a few years back. I can't remember if it was during COVID before, called The Newsroom, from Aaron Sorkin. And in the opening salvo, Jeff Bridges highlights that the United States spends more on defense spending than its next 25 countries, with 24 of those being our allies. Okay, so we spend a large sum of money. We all know that within the budget of that, call it $3 trillion, 800, 900 billion of that is for defense spending. But what about others? Okay, and this is interesting. And so there's some history with this when you actually go study it. We start with Japan being the next wealthiest country that has the ability to spend a lot of money but hasn't spent any. So the history lesson is this: politics aside, bias and culture aside. So I'm just going to speak about numbers and the history. But during World War II, after the United States, dropped the atomic bomb and won that war, President Truman sent General MacArthur to hold the hand of Emperor Hirohito. And they put a series of deals in place, which include the modern day tariffs today. So one of those deals was, you're not allowed to have more than, call it, 1% of your GDP go towards defense spending. And in return, we'll give you 200% tariffs, or we won't sell into your markets. So we'll let you enrich yourselves economically, but you cannot defend yourself militarily based on what just occurred. Okay, fine. Here we are 100 years later, and they have recently, called in the last 5 years, through a series of Abenomic views or any of the other prime ministers, changed the Constitution to allow the amount of spending to go from 1% of GDP back up to a historical threshold of, call it, 3 to 5%. Okay, that doesn't sound like a lot, but that's enough to start your military over. Aircraft carriers, fighter jets, submarines, etc. Tens and tens of billions, if not hundreds of billions of dollars to get that back up from less than 1% to 3 to 5% of Japan's budget. So that's the anchor that's going on in the background. Number two, when you just play the geography game about the Taiwan, etc., you've got Israel selling Iron Dome to South Korea, right? You've got the islands in dispute with Taiwan, all of that. So that South Korea is spending a lot of money, and they're wealthy. And then you move to Europe, and Trump, through NATO, everyone's been familiar with that scenario. He's basically said, I want you guys to pay your tab, and I'm going to remove the safety blanket that I've provided for a very long time. It's time for you guys to ramp up as well. And that, for Germany, who runs a surplus in their budget, has a lot of capacity. So they've announced that they're going to spend $1 trillion and take their defense spending to GDP from less than 1% to near 4 to 5%. That's $1 trillion more dollars. When you add all these numbers up around that, we're talking about somewhere in the neighborhood of 2 to 3 trillion. That's a T, David. Trillion.
Yeah, those are large numbers. I'm getting used to speaking in trillions. I used to speak in billions.
Yeah, I know that was long-winded, but the net message of it is that there's $1, $2, or $3 trillion with some rounding in there that's going towards defense spending. And that, in a simpler way to say, is that if the world had a baseline of, call it, 1% of their GDP to defense, it's on its way to 3%.
I want to stay with defense, but I want to pivot to our hemisphere.
Yeah.
You don't have to be a news junkie to know that the administration's moved a lot of military hardware near Venezuela. You say this is by design and maybe even part of a larger plan. You got to talk me through it.
Right. So I call it the game of risk. That's what we've titled it. And I'm not sure why some people call this, President Trump is playing fourth dimensional chess. I don't really know. But when we read the tea leaves of global macro, this is how we connect the dots. And I think these pieces are being lined up this way to the point where we have to take these risks into consideration, that they're that glaring to us in our investment process here. So if you took a very basic illustration of the periodic table, and you said the United States only has 5% of the rare earth elements that we need for missile guidance systems, defense, fighter jets, whatever it is, right? And you say to yourself, okay, well, China through Mongolia has about 25% of the world's rare earth minerals, and they hold us hostage in our negotiations over those elements. Okay, so how do we fix that? If you're the president, you say to yourself, I'm the best deal maker in the world. What can I do to remove my reliance on China, given we're de facto at economic potential military war with them at any given time, right? So the answers are this. Number one, you go to Canada, you make a deal with Canada, they got 5%. So the US goes from 5 to 10. Then you go to Greenland, you try to buy Greenland for Denmark for 10, 20, 30 billion, whatever the number is. It's just a rounding year now that we're talking about trillions, right? You get Greenland, that's another 5%. And at the same time, you get your base you have a base on the eastern shore of Greenland that monitors all the submarine activity out of Russia. We currently do that out of Scotland on the other side of those straits. So we'd like to remove our reliance on Scotland. Okay, so now we're up to 15%. We do a deal with the Ukraine. Will we ever drill there or mine there? I have no idea, but there's another 5%. So the U.S. is up to 20%. And then we go into Venezuela, and we've got another 5%. And in doing that process, we solve a couple other problems in the Western Hemisphere, which are very interesting. So the obvious ones is you remove yourself from dealing with both China and Russia.
I was wondering where we were going to go with this, because in your presentation you got a periodic table there. I felt like I was in chemistry class. I haven't seen that in a financial discussion in a long time.
It's interesting because there's just two last add-ons to that beyond the rare earth component. It's actually quite interesting when you think about it. So, and strategic. So people who've been around, got some gray hair, they went through the Cuban Missile Crisis. They understand by removing China and Russia from the Western Hemisphere, that's a big event geopolitically. But then at the same time, as you just mentioned, we've got 15,000 troops in Puerto Rico. That's interesting. One way to revitalize that island is to remove the supply chains for pharmaceuticals that we currently have or are held hostage by China. So whether it's aspirin or Lipitor for blood pressure, you can build all sorts of new manufacturing plants like you used to in Puerto Rico and enrich in that island and get their support of 20 million people there. And then finally, the most strategic piece of this, which maybe dovetails into tonight's speech by the president. I have no idea if he's going to touch on this, but we have, as you've probably seen in the news, taken an oil tanker, embargoed all the other oil tankers going there. The idea that we can turn the spigot on in Venezuela from 800,000 barrels a day up to 2 million or 3 million by having Chevron inside there already, that is the easiest way to make RBOB gasoline below $2 in the United States, which is also the simplest way to make this country feel a lot better about themselves into the midterm elections. So when we think about all that, it's if we're not that smart, David, if we can come up with it, I have to imagine all these people at the White House have come up with this and they've got all this support. So you've got this whole game of risk. And if you don't believe me, go look at the price of the Venezuela bond. The primary, sovereign bond is up from 10 cents to 35 cents. This is right out of a Jack Ryan script, David. I mean, go watch the 4th season of Jack Ryan on Amazon, and you're having a conversation about Venezuela, which the whole script is about that. A woman who comes into power that's very loved by the population. Coincidentally, the woman who's in hiding right now just won the Nobel Peace Prize, and she's trying to get back and forth from Oslo back to Venezuela. It's literally like a novel, like a thriller. They've got something going on here. It's like clear and present danger, whatever you want to call it. So I think there's some legitimacy to this, and it's all connected.
Do you think we'll hear any of that tonight? In the president's addressing the nation tonight. Is that likely to come up?
I think the conversation will be 1/10 or 1/5 about that exercise, but it'll be spun as drug-related, cartel-related, and we need to do what we need to do to win over there to save people. And then the balance of it will be about him testing sound bites for his agenda next year to try to hold on to the midterms. Otherwise, whatever we're saying here is that if they were to lose the midterms, another outcome if the House were to turn Democrat will probably be spending the last 2 years of that presidency just trying to impeach him for a third time for whatever the reason is. Doesn't matter. We're not going to get much done.
I can see that. We're going to run out of time here, and we can't finish off this conversation without going into the CapEx component of your thesis here, and that's of course the great AI debate. And there's a lot of news certainly in the last 24 hours regarding CapEx. Maybe the most important of that is the news that came out this morning. I think it's Blue Owl was pulling the financing for, I believe, a $10 billion project for Oracle, a data set of data centers in Michigan. Not that they won't find financing. There'll probably be other financing out there. But it seems like for the first time, we're day after day after day, we're getting some confirmation that there isn't unlimited dollars available for this massive CapEx spend, or at least people are being price sensitive about it. They're not just throwing money at everything.
Right.
Take me through that thesis.
Sure.
You're an excellent bond analyst as well, and this deals with credit markets, credit financing, all that good stuff that affects equity markets.
Yeah. Okay. Thanks for that question, David. So, for those not familiar with it, it took about 100 years up until this year for the Fortune 500 companies to spend collectively about $1 trillion dollars in capital expenditures or CapEx. The forecast for the next 3 to 5 years, or by 2028, we're going to go from 1 trillion to 2 trillion, and then 2030 to 3 trillion. So, I'm not sure what any of that means, but we're supposed to triple what we've done in 5 years over the last 100 years in terms of spending. Okay. So when I add all that up along with the fiscal, the deficit to GDP ratio, what we talked about defense spending, right? And you're talking about numbers somewhere in that $7 to $9 trillion range that by far just defy the laws of physics or gravity or however you want to describe it. And so a lot of money needs to find a home into a lot of things. Okay, fine. There will, on the CapEx side, it's going to ebb and flow. What I like to see is some selectivity, right? And some pushback on that. Everything is a free ride. And then at the same time, I'd like some people to be more humble out there that said, look, you can try to bet against Larry Ellison, which has been a pretty losing proposition for the last 30 years, where a guy still owns 43% of his company, is top 5 wealthiest guy in the world, and single-handedly funds anything Elon Musk wants to do. There are better bets out there than focusing on what that guy might get done, and recognize that the total return view, CapEx spending, is really the right answer. So to your point about Blue Owl or whatever, they're going through some other issues at the moment, and they're a private equity, private debt, type firm. There are lots of vehicles out there, and I believe the project that you're talking about got financed immediately from somebody else who was already announced, a different competitor. So right now, people are just cherry picking certain discussions. But similar to the deficit, the CapEx train left the barn. And I'll tell you when you really should get concerned. It's not when you hear about some Blue Owl, telling you, oh, my $100 billion private equity firm is filled up with data centers at the moment. This is when you get concerned. When Jensen Huang from NVIDIA or Mark Zuckerberg from Meta stand up in their earnings call and say, I think we're done spending money for a while, then you can give me a call. But right now, everything you're hearing from them is, if I don't spend 10 times more than what I want to spend, I don't know where I'm going to be in 3 years. So I know I need to throw darts at the wall, and I'm going to spend big. So I don't get caught up in the day-to-day minutia. The net is we got a lot of money to spend, David.
All right, so let's take it down to the equity markets and how they're reacting to all this. And certainly in technology for the last couple of weeks, they've been digesting this, and I'm wondering if it's less about the fact that the data centers are going to get built, the power centers are going to get built, we're going to need more electricity on the grid. But since there isn't this, there's obviously some price sensitivity out there. Is this really more of nothing more than a multiple reset for some of these names? Because for a lot of these names trading at 40 to 60 times for some names, very exciting futures, but every company on the planet right now has an AI policy, and we're getting some exciting news from some companies out there that are utilizing AI, but they're not trading 40 to 60 times. They're trading, 12 to 18 times. And maybe it's just some capital movement out there, just trying to find some alpha from some other part of the market. Because it seems like tech right now is just priced for no bad news.
Yeah, I like what you just said. A lot at the end of that I'm less intelligent. Like, I have less of a good answer for you on the first part about what is an appropriate valuation, 40 times, 50 or 60 times. And are we going through some type of multiple contraction associated with some of the themes that dominated earlier in the year? To me, there's no question we are. And by the way, that's not a surprise. The most overwhelming consensus view by equity strategists for next year is already some version of multiple contraction, starting with the AI or semiconductor space. So that to me is almost pedestrian. But the part that you said, where the companies, and they could be staples, they could be utilities, right? They could be industrials that are benefiting from that productivity impact. due to AI or robots or whatever it is, that's where the margins expand the most. So if the overall S&P 500 margin is at 14%, and we want to get to have a historical benchmark like in the 1990s when you referenced Bill Clinton and the surplus, the productivity expanded that margin by about 4% during that period. So if we went from, say, 14% margin in the Fortune 500 to 18%, to give you an idea, the math says in earnings per share translation that every 1% of margin expansion equals almost 20% historically in the index price. If that were to occur, you're talking about the
Repeat that one more time. That's a big number.
Yeah.
Did you say 20%?
Yeah, 1% margin expansion leads to 20% of equity gains. It's possible, David, we've already had 1 or 2 years of that productivity gains, and we've had 2% margin expansion. And so we're halfway already there. I don't really know. But what I heard from you about the idea that the other 450 companies that make things are figuring out how to get even more efficient or more productive, that organically expands the earnings profile beyond the Mag 7 or the concentrated risk, that would speak to a healthier market, while some of those people who are overweight, too much tech, have to go through a little bit of an update on their portfolio allocations. So that I would welcome, and I can see that happening. And maybe that's the trade, that there's a rotation that continues. And what's the old phrase, David? They call it time. It stands for technology, industrials, materials, and energy. And I'm sorry, or telecom. Maybe those are the ones that have that expansion and win. Winners do rotate.
One last risk I want to touch on, and maybe it isn't a risk. Maybe you view it as a positive. But I saw in your note, you started talking about equity risk premium, and I think you had in your note that the equity risk premium, we're at 20-year lows. Is that correct?
Yeah.
If that's true, all right, I would think that makes bonds, more attractive.
Yes.
And are bonds the place to be? And if that's true, why do we want our stocks at risk? Or can everything do well here?
So it kind of depends on the type of historical investment framework you subscribe to. But if you are a subscriber to what they call the equity risk premium, so for those who are not familiar with it, that's the S&P 500 earnings yield minus the 10-year U.S. Treasury yield, okay? And right now, as David pointed out, it's at a 20-year low. So it says you should favor bonds over stocks. And that's true. And then there are certain periods inside that where you need to see where the 10-year U.S. Treasury is, et cetera. There is an argument that you should own bonds over stocks. There's also, by the way, a much more interesting one that's been developing, that you should be augmenting that bond allocation with commodities now that they've opened up after a 15-year slumber, that they should be a portion, call it 5 to 8% of the portfolio, to augment the treasury component of that 60-40 portfolio. There's a reason for that, which is pretty much with what I described. If they're really going to go out and spend that many trillions of dollars on defense spending, any product that's in a surplus right now is going to swing to a deficit in commodities, meaning it's going to go from contango to backwardation, and it's very favorable profile for commodities. So the point being is that there is advent more for what I would call the multi-asset portfolio, David, that would include stocks, U.S. Treasuries, but corporate bonds, cash, real estate, and then maybe some digital in there. And that portfolio is reacting very well this year, up between 18 and 20% versus 60-40, which is up, depending on domestic or global, call it 11 to 13%. And with that profile that we talked about with CapEx, or with the deficit to GDP ratio, or with defense spending, globally, that correlates very well to a continuation in multi-asset performance. And inside that, what the equity risk premium is telling you is there may be more favorable profile for other assets besides U.S. equities at the moment.
It sounds almost like what you're describing as an endowment, like portfolio.
Own a little of everything is the answer, because that's actually the underlying crux of all of this entire conversation, David, is that at the end of the day, I don't know anymore what the difference is between 8 trillion, 9 trillion, or 10 trillion, and anything that I forecast could be off by $372 billion, right? What I know is they're trying to stick 10 pounds of bologna in a 2-pound bag, and that's a lot of bologna, and something has to go up, and it seems like everything is going up. So if you're an asset owner in the top 10% of the world, you're having a great time. If you live in that 30% to 90% world and you don't own assets and you think you're making a good living, that's a pretty challenging.
Neil, you're a PM. You run several funds out there. You've been doing it for a long time, very successfully. But we all have our demons. And as a portfolio manager, what keeps you up? What could go wrong that maybe we haven't talked about?
I'll give you two. I used to have a canned answer for that because there was always a standard. This was before COVID. You had this fear. One day you wake up, the stock market's down, real interest rates are higher, and credit spreads are wider, and there's nowhere to hide except cash in that scenario. So you just get blown up. The world's changed since then. So you ask yourselves, what could catch you off guard, as opposed to like what keeps me up at night? And there are two scenarios, and I'll tell you one, the easy one. If quantum computing, well, let me caveat that. Most people will tell you this is 3 to 10 years out. Okay, if they say so, they must be smart. They're talking about quantum computing. But theoretically, if that acceleration in compute power were able to crack the Bitcoin code, and Bitcoin dropped 90%, and gold doubled overnight, that would be a tail risk that bothers me a lot. If that's
I haven't
true.
heard this before. Wow.
So, and I've done the math on this, David, of like, you can own the $7,000 to $10,000 call option on gold, or the $30,000 put option on Bitcoin, and figure out which one has more optionality in it. Or if you had both sides, they call it a dual digital, how much money could you make on that? It seems like an incredibly cheap book hedge, right? And then the other one that bothers me a lot, that typically keeps me up, is crude oil. I know that seems so antiquated with AI and digital currencies these days, or robots. The thing is outside the United States, or mostly the developed world, it's still really about getting from A to B in the morning, and how much does that cost you, and what the barrel is doing. And so I still place a lot of emphasis on crude oil around the world. And when all of us saw it go negative during COVID, I get very concerned, David, that the tail of crude is an unknown because of what we saw during COVID. So when a specialist gets up there today and says, crude can't go below $53 because it's no longer economical, it's only economical at $76, and everybody's going to stop pumping. I just don't even know what that means. I saw it go to minus $35. And so when I see it at 55 and it went to minus 35 once, I say to myself, it's got $90 to go. If Trump wants to make it go down and he wants to tell Saudi Arabia to deal with it, and we take over Venezuela or put a deal in place without troops on the ground, and gasoline drops to below $2 a gallon in the United States and crude's at $30, I worry about that scenario on multiple fronts. One is, what does that do to your energy investments and that whole infrastructure? But two, what does that do to animal spirits on the other side of the ledger, where everything is less expensive? Trump solved the largest input into inflation, being gas prices or oil. And all of a sudden, animal spirits unleash, and we're growing at 4 or 5% in this country. What do you own? What pony moves the fastest in the race? So those things concern me when I think about
the oil one is one I've always lived with. But the quantum one, quantum breaking the code on Bitcoin, that's new for me. And now you've added another nightmare.
David, let me be clear. I know nothing about it. I don't work in IBM in the quantum computing department. People ask me that question. I don't know if that's real or if it's possible, right? Right now, I also don't know what Bitcoin actually does. And so I just am open-minded that there's a 0.1% or a de minimis chance of a tail risk. And it strikes me as a pretty cheap overlay or book hedge to those types of scenarios where you can make a very asymmetric payout profile if you wanted to add those things into your investment framework, which are things we look at where we look for cheap asymmetry for hedges. All right. So in case you're caught off guard, that strikes me as one of them. But would I bet on it? No. But would I spend 10 basis points of the NAV? Yeah, sure.
All right, I'm gonna cut it there because I don't want any more bad dreams than what you've already given me. Neil, if some of my the followers here of this podcast or those who see it on YouTube and all the other places it's going to appear, where do they go if they want to get a message to you, learn more about Rareview or yours truly, or I'm sorry, you?
Well, thank you for that. I mean, always our website is our storefront. Rareviewcapital.com. You can always send us an email too at info@rareviewcapital.com. You can follow me on Twitter at Neil Azous or any of our companies on Twitter, LinkedIn, et cetera. So we appreciate that support and hopefully we'll be able to produce some content that's helpful to you guys.
Neil, as always, thank you. Thanks so much. We'll have you back again real soon.
David, appreciate it. And again, happy holidays. Thank you for having me.
Yeah, you too. That was Neil Azous, Rareview Capital Management. Don't forget, if you want to learn more about yours truly or the Money Runner, go to my Substack site, dcnelson123 at substack.com. I'm David Nelson, and this is the Money Runner.